Welcome to Get Rich Education. I'm your host, Keith Weinhold. How do last year's financial stories shape your investing life today? And what can you expect to happen this year? And will you live before you die? Today on Get Rich Education. MC Lobsher is the host of the Cashflow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
Get Rich Education is brought to you by Ridge Lending Group, Producers Wealth, Norada Real Estate, and Total Control Financial.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Kiev, Ukraine to Key West, Florida, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education, and you are back for that necessary weekly dose of investing abundance, because the scarcity mentality is abundant and the abundance mentality is scarce. In the past year, you already knew that high-waisted jeans would stay popular, just like you knew how much mortgage interest rates would rise. Just like you knew Amazon would choose 2 new headquarters rather than 1, didn't you? No, you didn't. None of us did. Let's talk more about what this past year taught you and the lessons you can use to project ahead and be a better investor tomorrow. But first, realize that we need to temper the meaning of asset capital values and bring some context to them, since you might be more focused instead on the income stream. So, context before content here. When mainstream society thinks about successful investing, here's what that looks like to them. Number one, they've got to achieve a capital gain, like in a stock or an ETF or a mutual fund. And number two, they must time the market successfully, not just once, but twice, both going in lower and then coming out of the investment higher. That's harder to do than it sounds, even during this long run of capital appreciation in most assets. How do we know that it's hard? Because even most professional fund managers can't beat the S&P 500 index benchmark over the long term. And if that isn't bad enough, then the mainstream investor has to pay tax on that gain if they're fortunate enough to have successfully timed the market twice. Now, if it's in a tax-sheltered vehicle instead, it's possible that could end up being even worse, because now you can't even enjoy the benefit after working for 40 years penalty-free until you're old. Well, what a scarce mindset. The main point of investing is so that you can live better and give better, not defer life, not be relegated to a market timer, not having the pressure of trying to successfully time the market twice and everything else. Does that sound like investing to you? Well, perhaps 98% of Americans and Canadians and elsewhere, perhaps 98% of people think, well, that's just what investing is. They don't even recognize it for what it is, which is speculation. Many of them even think, now, how could you enjoy life? Aren't you supposed to defer life? Life isn't to be enjoyed, it's to be endured. That's how most think. That's a result of scarcity finance, and they're building pools of money. You, on the other hand, are building streams of money. And you know what's interesting? Your streams of money flow all of your life, not just beginning at retirement age. That's the good news. Plus, you're probably going to build a bigger pool than them by the end anyway, while you've also got the streams all of your life. That's because they've merely got compound interest and you've got leverage. Their scarcity finance is building a pool and then only tapping that pool at retirement and adhering to something like the old 4% drawdown rule, for those that still believe that, meaning that in retirement, they feel that they can tap 4% of the value of their account, their pool, per year, and just hope that the money does not run out before they die. Those people don't have streams to support them. Generations ago, the corporate or government pension, that was a stream. People need to wake up. That stream is gone. The 401k, the 457, the 403b, that is all just a pool. Most people's mindsets and actions have still not changed with the times. Most people that think that they have a money problem actually don't have a money problem. They have an idea problem and lack of money symptom. This is get rich education. We don't cling to hope and we don't time the market, but we'd still rather have a real estate capital asset value go up rather than down because, after all, we legally don't pay any capital gains tax either. So with that backdrop and bringing some context to what a capital gain really means to you, let's have some fun and run the numbers. Let's see what really occurred last year, because I think some people are always looking only at what's next, such that they don't even know what's actually happening now. And then we'll see how that shapes your investing actions and mindset for your year going ahead. And then we'll talk about some predictions from experts for the next year or two. Real estate appreciated 5.5% year over year. Yes, that's merely a Case-Shiller national number. And of course, there are hundreds of different housing markets. Also, that's 5.5% October to October, as there is some lag time with that number. As we know, just say you've got 4-to-1 leverage, well, then 5.5% appreciation on your asset is 22% of appreciation on your investment amount. Now, everything else here is for the last full calendar year, January 1st to December 31st. Mortgage interest rates are only up about 0.5% year over year. That's because they have dipped recently. They had been up about a full percent year over year previously. The yield on the 10-year T-note was up 27 basis points. And now to translate that for you, T-note means Treasury note. 1 basis point, that just means 1/100th of 1%. And the 10-year T-note is important because that is where long-term mortgage interest rates are derived, like your 15 and your 30-year loans. Inflation year over year was up 1.9% per the Consumer Price Index, a dubiously low number in the way that it's calculated. Well, what about stocks performance? We don't talk about stocks very often here, but it's worth bringing into the conversation from time to time as it is a sentiment indicator. And on the year, what do you think? Do you have any idea where it all settled out? The Dow Jones and the S&P 500 were each down 6%. That technology-centric indicator, the NASDAQ, was down 4%. Volatility was also in style every bit as much as high-waisted jeans. The S&P was up or down more than 1% 9 times in December alone, compared to just 8 such moves in all of 2017. Tech shares came tumbling down from glory as both sales growth prospects and lofty valuations came under the microscope. Energy names struggled amid falling oil prices, while trade-sensitive industries like automaking and manufacturing, they continued to falter, care of Beijing and DC's ongoing trade war. President Trump traded barbs with Fed Chair Jerome Powell over several interest rate hikes.
I put a very good man in the Fed. I don't necessarily agree with it because he's raising interest rates. I'm not saying that I agree with it, and I don't necessarily agree with it. I must tell you, I don't. I'm not thrilled because, we go up, and every time you go up, they want to raise rates again, and I don't really, I am not happy about it.
The problem that I have is with the Fed. The Fed is going wild. I mean, I don't know what their problem is, but they're raising interest rates, and it's ridiculous.
I think the Fed is making a mistake. They're so tight. I think the Fed has gone crazy.
Oh boy, that is very interesting. And it is not normal for a sitting president to say things like that, as instead, there's been a tradition of independence between the presidency and the Federal Reserve. In the last year, Facebook took many shots on the chin about privacy, especially the Cambridge Analytica scandal. November's California wildfires took a lot of lives and damaged a lot of real estate too. The Camp Fire alone took down nearly 19,000 structures in Northern California. Cryptocurrencies tanked. Bitcoin had the most notable fall from glory, from about 20K falling down rock hard with a thud to about 4K, such that by mid-December, Bitcoin fell so much that the price was lower than the cost to mine it. Gold was down 4% on the year. Oil was down 25% amid concerns of oversupply and a slowing global economy. Rather quietly, minimum wages got a bump in at least 19 states and 21 cities on or around January 1st, 2019. Even if you earn substantially more than the minimum wage yourself, you know that minimum wage bump-ups stoke inflation, which is good for us long-term fixed interest rate debtors. Publicly held corporations based in California will be required to have at least one woman on their boards by the end of the year. The partial federal government shutdown looms with all of its deleterious trickle-down effects. Is there a real estate slowdown in New York City? NYC existing home inventory ballooned 17% from a year ago, while apartment sales slowed more than 3%. That means prospective buyers, who also enjoyed an average list price discount of 6%, have more negotiating power in New York City. Of course, here we avoid investing in the more volatile, highly priced coastal markets altogether. A more recent plunge in mortgage interest rates has sparked a big spike in mortgage applications per the Mortgage Bankers Association. A sharp drop in interest rates to the lowest level since April sparked a bit of a boom in mortgage refinancing. Buyers returning to the market after the holidays may have been inspired by the drop in rates, but stock market volatility and the government shutdown could keep some of those mortgage applications from closing. In fact, just over 10% of real estate agents surveyed by the National Association of Realtors, they said the shutdown was having an impact on their clients. Even within this era of historically low mortgage interest rates, after an uptick, interest rates, which is the cost of money itself, has indeed gone down in recent months. So that completes the asset class whip around, which is something that I provide for you here every once in a while. Now, with that said, let's extract another learning moment from this. This is Get Rich Education, after all. Long-term mortgage interest rates, like 30 and 15-year mortgage loans, they are not tied directly to the federal funds rate, as we've discussed before. Instead, these mortgage interest rates are tied to the yield on the 10-year Treasury note. A Treasury note is basically the same thing as a bond. Technically, the difference is with their maturity length, but let's just make this simple for you here. Now, although there are exceptions to this, here is what generally happens. When people are bullish on the stock market and they buy more stock, money comes out of bonds and goes into stocks. Well, because money and demand came out of bonds, bond prices therefore go lower. Bond prices have an inverse relationship with bond yields. So when those bond prices go lower, bond yields go higher, and higher bond yields, like that yield on the 10-year Treasury note, means higher interest rates because the 10-year T-note and mortgage rates have a positive correlation. So that is why a higher stock market often means higher interest rates. And this is also why people follow the yield on the 10-year Treasury note, and that yield has been between 2.5% and 3% lately. Now, Housing Wire reports that buying and selling a home is going to be more difficult this year than it was last year. Realtor.com explained that rising interest rates and home prices will overshadow any inventory increases in the year to come, and that's why home affordability is set to get even worse, making it more difficult to buy or sell a home in 2019. The forecast predicts mortgage interest rates are going to average between 5.3 and 5.5% by the end of 2019. And now these are primary residence rates. That would make the average home purchase 8% more expensive per month than it was last year. Home price growth is also expected to continue, but rising at a slower rate than that 5.5% I mentioned earlier. Inventory increases are also going to moderate with a less than 7% projected inventory increase, and the result of all that will be about a 2% decline in home sales. That's the Realtor.com prediction. Now, their chief economist, Danielle Hale, she said that inventory will continue to increase this year, but unless there is a major shift in the economic trajectory, we don't expect a buyer's market on the horizon within the next 5 years. Unfortunately for buyers, she says, it's only going to get more costly to buy, especially this higher demand entry-level real estate. To be successful, buyers should think through how they'll adapt to higher prices and rates. That's the end of what Realtor.com's chief economist Danielle Hale said. See, it's that entry-level real estate, those properties we focus on buying here at Get Rich Education, they're the ones that continue to have strong demand, and that is just going to become even more true in an affordability crunch. Now, Realtor.com also forecasted what the market will look like for both home buyers and sellers in 2019. Now, here's the 2019 statement for home buyers, not sellers, home buyers. Buying a home will be an even more expensive undertaking in 2019 as both mortgage rates and home prices increase again. Buyers who are able to stay in the market will find less competition as more buyers are priced out, but they're going to feel an increased sense of urgency to close before it gets even more expensive. Their largest struggle in 2019 will be reconciling wants, needs, and budget versus the heavy competition of last year. Although the number of homes for sale is increasing, which is an improvement for buyers, the majority of new inventory is focused on, and here it is again, it's focused on the mid to higher end price tier, not the entry level. Rising mortgage rates and prices will keep a lot of new inventory out of their budget, and it's going to make it especially tough for first-time home buyers who have historically been a much larger share of home purchase activity. Okay, so that includes 2019 for home buyers. And as you can see, that increasing difficulty for first-time home buyers is going to be good for you because they're going to have to continue to be your renter. Now that we discussed home buyers, let's discuss Realtor.com's 2019 outlook for home sellers. Although it remains a seller's market, sellers are going to need to be mindful of their increasing competition and should not necessarily expect to name their price and just get that price in full. And that could be a change from the past few years. Homes priced above the median are going to take longer to sell and could require offering incentives such as price cuts. With less demand in the market for these mid and higher tier homes, there will be fewer bidding wars. However, with inventory expected to remain limited in most markets, sellers who price competitively, they can still walk away with a handsome amount of profit, but not the price jumps observed in previous years. Okay, so that was their statement for home sellers. So prices should continue to increase, but not as much as the recent 5.5% year-over-year Case-Shiller increase. Realtor.com, interestingly, they also noted that millennials are going to continue to make up the largest segment of home buyers in 2019, and get this, account for 45% of all mortgages. Yes, millennials are a big cohort, but that is just astounding. Nearly half, 45%, for millennials alone, compared to just 17% for baby boomers and 37% for Gen Xers. In fact, 2020 is expected to be the peak millennial home buying year. Yes, that is just next year already, as the largest cohort of the generation will turn 30 years old. Millennials are also likely to make up the largest share of home buyers for the next decade as their housing needs adjust over time, according to the forecast. So that's the end of the Realtor.com total outlook there. Next week here on the show, legendary investor and popular and renowned financial commentator Jim Rogers will join us from Singapore. He is, of course, an illustrious American business mogul. He was the founder of the Rogers International Commodities Index and was also one of the founding fathers of the Quantum Fund. He's been one of the most quoted and followed financial minds of the last decade plus, and you will be graced by his presence here next week. A lot of people hang on Jim Rogers' every word. Will you live before you die? You were probably treated to that little episode last week. If you don't know what I'm talking about, then it's because it may not have occurred in the regular feed. So that's why we're going to play it again for you here to be sure that you hear it and let you think about it. There are also a couple surprises about this, some things that you do not know that I'm going to tell you about. We're talking about investing and mindset motivation, channeling Norman Cousins here. The tragedy of life is not death, but what we let die inside of us while we live. Yeah, there's so much to be said for that. This is all straight ahead on Get Rich Education. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is Rich Dad Advisor Tom Wheelwright. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
If you work for a salary or a wage, then money is an important factor in your life. So there you are, making between $60,000 and $150,000 per year. You've got a good home, steady employment, you drive a decent car. Sometimes you even feel comfortable. This one precious life of yours is made up of time. Are you trading away that time for dollars at a job that you aren't even passionate about? Every morning, you might even separate yourself from those you love in order to do this. With real estate investing, you don't want properties so much as you want its passive income that you don't have to work for. Now, your eternal time versus money dilemma is solved. If you don't know why you urgently need financial freedom, do it so that you can be yourself. See, you wake up to a blaring alarm to get to your job, and that's how your day starts. Then you're programmed to tote company lines all week. Near the end of the workday, you're playing another tireless charade, screwing around on the internet while you're watching the clock like it's a countdown timer so you can get out of there. That's unethical. You aren't being yourself because you wouldn't naturally do those things. Most employees aren't driven by purpose, they're driven by fear. Your growth can only begin when you peel back each layer of your vulnerability onion and get honest with yourself. The roots of change are nourished with genuineness. You'd rather quit your job and be a nature photographer or a Red Cross volunteer or a sports writer or travel. Even if your job is okay, wouldn't life be better if you were job optional? You haven't created the time to feel peace, joy, happiness, giving, love, and freedom in your life. You spend all this time learning how work works, zero time learning how money works, yet money is the only reason that you even go to work. Look, you won't obtain freedom by getting your money to work for you. Every dollar that you put in a stock or 401k plan can't leverage other people's money. For freedom, you must ethically employ other people's money. That's the mindset shift. Real estate gives you limitless access to other people's money, the banks, the governments, and your tenants. When you have enough passive income to meet all of your expenses, you can quit your job and be free. Real estate is the generationally proven way to build wealth, and you don't even need any degree or certificate. That's why I talk tirelessly on my podcast and in videos and articles and newsletters and wrote a book and keep visiting the best geographic markets to find the right opportunities and properties and to meet the right people. In this one life of yours, you can either be a conformer or you can build wealth. Once you have time freedom, whether or not you want to go on to be rich from there, well, that part's up to you. This is an unselfish act because when you do what you love, you'll produce better results for both your family and society. You can't help others if you're poor. Don't live below your means. Expand your means with anything that you do in life. The sad thing is, you have a choice in this, yet you're selling your time and your soul for money, and that's what breaks my heart. Learn how to invest in real estate the smart, patient, stable way. Most people get used to settling in life. When you were 12 years old and thought about your adult life, I'll tell you one thing that you never thought. Someday I'm going to live a small life. Well, now that's precisely what you've done. Get real with me. How much did your employer pay you to quit your dreams? Do you even remember what your dream was from when you were 12? I bet you've forgotten. When your dreams die, you die. Most people die at age 25. It's just that they're not buried until age 85. Will you live before you die? Yeah, that was Live Before You Die there. You know, listening back gets me somewhat introspective too. Did you know that this is more than just an audio experience? Live Before You Die is in fact a forthcoming video. Well, I just watched the video and audio with you as you listen, and I've got to say, this is a Strange position to be in, but as I listen to my own words there, it makes me think about my own untapped potential, probably every bit as it does yours. We all have a gap there, some just greater than others. Now, I've had some people here, those involved with making the video, well, they've said that it makes them cry when they watch it. I don't want to make you cry, but I want this to help us think. And if you need to cry on the way toward helping you think, that's okay. Go right ahead. In the video, you'll see a few scenes with me and some of the guests that we've had here on the show. But I think more importantly is that I'm hearing that you can kind of see yourself in the video as you relate to it. Well, I definitely want you to see the video too, and it's going to be ready really soon. The way that you can ensure that you see it is to be on our email list. We'll be sending it directly to you shortly. If you're not on the list, all you've got to do is sign up for our valuable wealth building newsletter at getricheducation.com. Probably something that you need anyway, and we'll send the video directly to you once it's ready. Next week, legendary investor Jim Rogers is here. Whatever you do, make sure that you live before you die. Make sure that you get our newsletter at getricheducation.com, and don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
As America's third largest city, Chicago, Illinois has big economies of scale for real estate investors. But there are problems with investing in highly taxed, fiscally strapped Illinois. You can beat it when you invest in Chicago land, staying on the Indiana side of the state line. Your property tax on a median Indiana home is less than half that of an Illinois property. Forbes ranks Indiana as one of the top 10 states to do business. With typical rents at $1,250 and purchase prices at $125K, Northwest Indiana numbers work. Learn more and connect with the turnkey provider at getricheducation.com/Chicago. That's getricheducation.com/Chicago.
71% of Americans aren't saving enough for retirement. It's going to get worse as people live longer, and you need to start thinking differently. But you can't lose your time. Real estate is the investment vehicle that's made more ordinary people wealthy than anything else. Keith Weinhold of Get Rich Education is host of one of America's top investing shows, Disrupting Wall Street. He's an international best-selling author, a writer for Rich Dad Advisors, and has been an active income property investor since 2002. He has created thousands in passive monthly income for countless followers, and now he has a free book, The 7 Principles for Creating Wealth in Your Life. Get your copy now at getricheducation.com/book. That's getricheducation.com/book. Because invest in what produces income for you now and later. Sign up now at getricheducation.com/book.
The preceding program was brought to you by your home for wealth building, getricheducation.com.